Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into Financial Focus, brought to you by the best of the best in financial services, 8 years and running, as named by the readers of the Lake City Reporter, celebrating their 30th year serving North Central Florida proactive planners, savers, and investors. The team from GulfCoast Financial Services, your resource, ladies and gentlemen, and founder and CEO John Kuykendall here with us, as always, providing the perspective and guidance, uncomplicating the financial world. John, today, no exception, a much debated topic and a much necessary component of a comprehensive financial plan. We are talking about the ultimate protection for our loved ones' life insurance and some of the complications and misunderstandings with life insurance today.
Well, Peter, when you hear life insurance, the average person's mind just clicks off. They don't want to hear about life insurance. It's the most unwanted topic there is. I guess next to life insurance would be annuities, but life insurance has been known in the past. We sold it for years and years as a death benefit, and it's just so much more today with with us living longer and needing more money in retirement and having to come up with more ways to find tax-free retirement and also find ways that we can handle long-term care. Life insurance has evolved into what I feel is a much needed, as you said, component of our retirement plan, but probably the hardest one to convince an individual that it really works the way we say it works, because it has that stigma of death. And I think what we need to think about is that, life insurance just isn't for death anymore. It's for if you live, if you die, or if you have a terminal illness, it can be used for all those things.
Yeah, John, at the surface level, you say we're living longer. And so the natural question is, well, then why is life insurance going to be of value if we are living even longer? But in retirement, we're spending more money over those years and therefore have some potential of spending down some of our savings, which life insurance can serve to supplement or replenish. And so we really need to have an understanding of what life insurance can and can't do for us. And then the different times and places where different types of life insurance may be valuable and most appropriate. So we'll get into that today, but don't forget, ladies and gentlemen, if you have any questions about any of your financial matters, investments, consideration, and planning, pick up the phone and give GulfCoast Financial Services a call. John Kuykendall and his team, they are your resource, ready to serve, ready to talk, ready to help you through any kind of financial decision, planning, and considerations. 386-755-9018. That is 386-755-9018. 386-755-9018. So, John, I guess let's start at the beginning, very high level. There are different types of life insurance, and we need to understand what those different types do and don't do.
Well, that's right, Peter. First of all, we have term insurance. And term insurance serves a particular purpose. It's to protect the loved ones in the early stages of our marriage when we bought a house, we have debt, we're having children, and we want to make sure that if something happens to the wage earner, whether it's the lady or the male, that we would have income coming in for them. And so we have different types. We have reducing term, which reduces every year based upon your mortgage payment going down. Level term, which is for a particular period, which will pay the same death benefit along. And then there are different payment methods. You can have annual term, you can have a term for a term. So we need to make sure that we get the right particular policy for our needs and to meet the needs of our loved ones. And then we have permanent insurance. And permanent insurance in the past has been whole life insurance. That's what we started with, where the insurance company would pay you a small cash value. And so as you had the insurance and made the payments on it over a period of time, that cash value would increase. And at some point in time, you had the ability to let the cash value pay for the policy, or either you could take the cash value out. But it didn't build a lot of cash value. Recently, we've come up with, an IUL which was an universal life insurance policy. And then we came out with the indexed universal life insurance, which I really like the index because it gives us the same benefits that an annuity does, a fixed indexed annuity, and that we have a chance to make a lot of money based upon what the market does and the indexes that we choose. So the life insurance today is a lot more complex than it has been because we have so many options, and you really need to see your financial professional to get a determination of what you need and how it will work in your plan.
Now, John, as I understand it here, term insurance generally the cheapest bang for our buck. Now, cheapest doesn't always equate to best. And while term is a way to pay a minimum amount to cover a large potential liability and need, in other words, a large death benefit, that term is going to go away eventually. And I think that is where the insurance industry actually makes the most of their revenue and income, because they generally don't issue term policies to people who have any kind of likelihood of actually dying and collecting during that term. And a lot of those additional benefits you mentioned just are not included.
Well, that's right. Other than return of premium, that's about the only benefit you're going to get on a term policy. And I think the industry standard used to be about 97% of all term policies never pay. And they do serve a purpose. And if we need that protection, and we need a lot of protection and we can't afford it early on, it's a good way to go. But don't forget, Peter, there's something that you talked about just then called insurability. And it may be a situation that when that term runs out, I'm older, my cost of insurance costs more, or I may not be insurable because I've had heart failure or some disease that would make me non-insurable. So it's always great to have a combination of both if you're trying to get a lot of insurance, something that you can keep for a long period of time forever, and something that will go away as your needs go away. Not everybody needs $1 million policy. In fact, some insurance companies, because the price of term is so cheap, have quit writing term policies altogether.
So again, term may be a good value for the amount of coverage that you can purchase, but it is going to go away. There's the end of that term. John, I think that many term policies can be continued beyond the initial term, but the price ends up increasing exponentially if you do choose to continue it, and probably doesn't make a lot of sense most cases.
No, Peter, I think I remember back, I had a term policy that I was paying like $600 a year for. And then when it matured 20 years later, the policy was like $3,000 a year. So, term policies are going to go up as you get older, and you're not going to be able to get the same terms. So it will continue. It's kind of like having also employer's insurance. A lot of people say, well, I have insurance through my employer. Well, that's fine as long as you're employed. But when you quit and try to convert that to some type of permanent insurance, the premium is going to go up and you're not going to be able to afford it.
So turning the page, we've got permanent insurance and a couple different types and options there. But the bottom line, John, once you prove insurability, you qualify, you get the policy placed and pay the premiums over your lifetime, you've got that coverage and that guarantee of death benefit down the road.
That's right. As long as we make the payments and pay the premium annually or however we're paying it. then that policy cannot lapse and you have that coverage forever. And that's something that gives you that peace of mind. And also, we're talking about later in life when we retire, we think, well, I'm 65, I'm not really going to need insurance because I'm out of debt, I don't have any debt. But as we talked about on this show over and over again, taxes are going to increase. Things that we buy are going to increase. Inflation, we know inflation's here. Even when we get it under control, we're still going to have inflation. And so you have that widow's penalty that we call it, that they're going to lose 40% of roughly of their income when one spouse dies because we only get to keep one Social Security check. So the life insurance can make up for that. And it's also a way that we can do other things. We've had some cases where the people weren't eligible for long-term care insurance. And so we were able to place life insurance that had that long-term care component where we could take $150,000 in this case of death benefit and put it aside and use it for long-term care. So it worked out really well. And it does a lot of different things. Like I said, it's not just for death anymore.
Yeah, let's talk about some of these additional uses and utilizations for life insurance. Not just for death, can be used while we are alive. One of the biggest evolutions in life insurance, John, is the ability to use that death benefit to cover the potential costs of long-term care or chronic illness. Can you talk to us about why this is such a valuable evolution for the way that life insurance works and such a useful tool for many folks as they face this question of how are we going to cover long-term care expenses?
Well, in Florida especially, we're not able to really purchase long-term care insurance. All the carriers have walked away because actuarially we didn't account for it properly in the beginning. I got a notice the other day where the little policies we have, the few we have left, John Hancock, are going up 40% next year in their premium. So long-term care is very expensive. Long-term care insurance, long-term care is expensive because it continues to go up as inflation goes up. And so what we can do, what the insurance industry has done, has made it possible to do, as you said, chronic illness or terminal illness or long-term care protection. We can use life insurance for that because those components have been added to these policies. So what happens is we take a percentage of the face value of the policy. Say we have a $100,000 policy, let's say 75% of that can be used for chronic illness. So if I need chronic illness protection, I can use that. If I'm going to die and I've been diagnosed terminal, I'll be able to get that money out and do some things that I need to do and make sure that everyone's protected before I leave. It just gives you that peace of mind, Peter. And it wasn't always there. And it's great the way it is, but the education part of it has been very difficult. Perhaps the biggest component that I see is if we start early enough, and I'm talking about even people in their 50s and early 60s, we're able to build in these new policies cash value that we can take out tax-free as long as we don't crash the policy. And we can use that to supplement our income and not affect all the things that that are affected in retirement. I don't have to worry about my Part B going up. I don't have to worry about my Medicare supplement, my Medicare drug card going up. I don't have the surcharge because I make too much money. All that comes out tax-free as long as we keep the policy alive. Cash value that's able to be built up in these policies nowadays is one of the most important things I think that we have and that we should be able to use. But so many people shy away from it because they don't understand it.
I've heard a lot of conversation, debate on both sides of this particular aspect of life insurance. Some that are completely against it, kind of closed door, not even looking to entertain a conversation. And then I've heard some advocates for the cash value component and the value of that for life insurance. I guess one of the fundamental explanations that I heard about the cash value component, John, is that normal people borrow money and pay somebody else interest in order to make purchases.
Mhm.
Smart people save money and then pay for those same things. But when they pay for it, it removes that money from their wealth building power. While truly wealthy people tend to use appreciating assets as leverage to make purchases. And the argument that I heard said that that is essentially what you can do within a properly structured cash value component of a life insurance policy. Can you explain, is that correct, and how that works?
Well, I think it's what we talk about, using other people's money. I mean, you know, if you're smart, we're able to leverage this by taking this cash value that we built up and taking it out cash free. Also, don't forget that life insurance passes on death tax free. So there's no taxes on the part of the life insurance policy that's still there. I think that, you know, if I had thought about this a long time ago, if this had been available, I would have been able to take money and place it into a life insurance policy. And then actually I could go get a loan and make the premiums. And then after the cash value built up in 5 or 6 years, I could pay that loan back off and have a tremendous amount more cash than I would ever have doing it the way that I did it. But this has only been around for a couple of years now, what we call premium financing. And so it's a way that rich people have been doing it for years and have been able to build up huge amounts of cash value in life insurance policies, and been able to leverage that money. So it's amount of leverage, Peter. You know, it's oftentimes, why would I want to, why, if I can borrow at 3 and I can make 8, why would I not want to borrow? And so it's all about leverage and how we structure ourselves. And unfortunately, the average person would do it, as you said, rather save up or either borrow it and pay it back, pay somebody else interest. It's a lot better to have this for yourself and not have to worry about it, but have that tax-free benefit built up.
John, fair statement. And in your opinion, would you say that throughout the different phases, the course of life, there is a consistent need for some amount of or value in having at least a certain portion of life insurance?
I can't think of an instance when a person shouldn't have life insurance in their portfolio because, like I said, it passes tax-free. It's the only vehicle we have that passes totally tax-free, and there's no strings on the death benefit. And then it also has all these other components that we have. The only thing we have to remember, Peter, is we have to get there. And actually, life insurance is written now up into the 70s. So you can buy life insurance a lot longer. We used to think that you know, when you got to be 60, you couldn't get any more life insurance. Well, that's not right. If the policies are there, they're cheaply quoted, but insurability is the key. And I can't wait and, you know, until later in life. I should get this as soon as I can, so that I can know I can get insurability. I know that I can get the cheapest rate I want, and I know that it's going to benefit my policy.
Again, speaking with John Kuykendall, founder, CEO there at GulfCoast Financial Services, discussing on today's program life insurance, the different types, the different uses and utilizations, how they function, what you need to know and understand, the ways to use it. And it is much more flexible than it was perhaps just a decade or two ago. And there is a value in understanding the different uses and utilizations of modern life insurance. John, even if we have an older life insurance policy, because of these evolutions and adaptations, it's probably going to be beneficial to examine that older policy to see if it includes some of these modern features.
Well, that's right, Peter. And most of them don't. And so, you know, that's one of the things. Also, don't forget, because we're living longer, the actuarial tables were rewritten a couple of years ago that actually make life insurance cheaper. So if you have an old policy, you should have it reviewed and you should know what's in it. but also these new policies are cheaper than we ever thought we'd be able to get them. So it's certainly something we should look at. But the thing is that people have to act. And it has to be part of a retirement plan. Just don't be buying insurance to be buying life insurance. Understand what you're buying, understand the need for it, and put it in part of your income plan that we talk about on this show all the time. And make sure that it's one of the arrows in the quiver that will make your retirement the one that will be the best one you can have.
John, I've heard the term LIRP, life insurance retirement plan or planning. Maybe not the end all be all of everything that our retirement plan should be based upon, but something that could be included as part of a comprehensive plan.
It's just one of the tools. It's not the tool. It shouldn't be a major part of your plan, but it is one of the tools that we have to look at when we look at everything. We look at insurance, we look at taxes, we look at income, how we're getting income, and we look at investments. And it's just life insurance is just one of those tools that needs to be included in everybody's plan, but certainly not the major component of the plan.
Once again, talking with John Kuykendall at GulfCoast Financial Services. Questions about your financial, investment, retirement planning, your insurance coverage. Pick up the phone and give a call, 386-755-9018. That's 386-755-9018. As always, John, we appreciate the time and the informative perspective on this important factor.
Thanks, Peter. Great to be here. Have a good week.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities, Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services, Inc., a registered investment advisor in Florida. GulfCoast Financial Services, Inc. is not affiliated with Kovac Securities, Inc. or Kovac Advisors, Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors, including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.